Okay, Assalamualaikum warahmatullahi wabarakatuh and good morning. Welcome back and good to see you again. So today we are going to have a co-sharing session with Dr. Salwa, but I will start the session first because she's now having another class in IIUM. So what we are going to do today is just to have a revision of what we have covered so far with you. And we are going to look into the topics that will be covered in your final exam. Yeah. So we have actually prepared the question. Okay. So today my location is a bit different because I have to do it in my dining area. Okay. So for your final exam, the topic is your tax planning, which we do not cover. I believe that you cover this topic with Dr. Hamima. All right, and then we have estate, we have trust, and we have fourth question, audit and investigation. So what I'm going to do today is to look back, all right, just a simple revision on the topic of estate and trust. And Dr. Sawa will continue with the topic on audit and investigation. All right. On the estate, right? Estate is actually looking at the wealth of the deceased person, right? So what we are doing now is that we are going to compute the tax liability for the deceased person and also for the executor. And normally the question given is for the year of the death, all right? So it means that you have to do two computations. One column is on the deceased person, means that from 1st January to the date of death. And then the second column is on the executor. So you're going to divide the income of the deceased person into two periods. All right, number one period for the deceased person, and then the other one is for the executor. Right, so whatever income, in this case, you can have income from section 4A, business income. You can also have income from your section 4C, for example, your dividend interest. And then you also have income from your D. Normally, it's most likely it's going to be rental income. Yeah. So that is the three types, the main types of income that normally we ask you in the question. So what you do is that number one is that you have to compute the adjusted income of each source. Yeah, adjusted income from your business, adjusted income from your dividend. Dividend normally is either final or exempted, right? And then dividend income from your interest and dividend income. Adjusted income from your interest as well as adjusted income from your rental. So in order for you to compute the adjusted income, for example, from your business, all right, given income, you have to allow minus allowable expenses only. All right, depends whether you start from the profit before taxes, then you have to adjust. All right, you add back non-allowable expenses, then you come to your adjusted income. Sometimes you're also given the capital allowances. Yeah, so do compute the statutory income. All right, so you have to be familiar again with the format of your tax computation. All right, so you have that profit before tax, adjusted income, statutory income, minus loss brought forward. Then you add with other income. So here you have your dividend, interest, and rental. Then you come to your aggregate income. Yeah. From your aggregate income, normally you minus your current year loss, assuming that your business income having adjusted loss. Yeah. So if you're having losses in your income business, then you can deduct your current year losses against your aggregate income. Then you minus your annuity, which is a new term, all right, the new computation under estate, you have annuity payable, right? It's not annuity paid, but annuity payable. So whatever amount paid, and remember that the annuity is paid during the executor's period, not during the deceased period, yeah? So under the executor, you are going to have one more annuity. And then what else? Okay, if you have any approved donation, you have to look at whether the donation is made during the deceased person or during the executor's time. Yeah, so careful with that. So then you have your total income lah for your estate. So it's done. All right, not much on the estate. It's very straightforward. All right, it's just what I would say is a warm up for your trust topic. Yeah, but on top of that, you also have to understand the concept of domicility, for example. Yeah. So what happened if a domicile? What is so important about domicility? What if a person died domiciled in Malaysia? What is the tax implication, whether on the individual or on the executor? Or what if he is not domiciled in Malaysia? So you have to understand that concept under estate. Yeah. And then maybe the importance of the having appointing an administrator, for example, yeah. So that is your estate. So how much time do we take that? We only have that about 7 minutes, yeah. So 10 minutes for your estate revision. Any question on estate? Yeah. Any question? Do you think that you can do the estate?
The question will be like how we practice in the class, something like that.
Yes, but it's not that straightforward. All right. So, but you must understand the concept. Then you should be able to do that. Right. As long as you understand how to compute your adjusted income from your business, everything, and then you follow the format, then should be okay. Other than that, of course, the example
Do
in
we
the
have theory part? No,
yes,
just
we do have
test
that. We have
completion.
both theoretical and the computation part. Any more? I think that the total marks for estate is 20 marks, I think. Yeah. So it's a good, it's good lah. I think that you can do it. Any more question before we move into your trust? Any more? No. Can we move into trust? Okay. For trust, all right, remember that trust is a continuation, normally is a, rather than you, assuming, okay, remember estate, all right, whenever you distribute the income to the beneficiaries, the income is not taxable in the hands of the beneficiaries. Because why? It's a one-off, all right? So once you have decided all the liabilities, everything, then you're going to distribute to the beneficiaries. Is capital in nature in the hands of the beneficiary, therefore it's not taxable. But when you go into trust, all right, remember that trust is created, all right, it means that the source of income will be maintained. All right, you will continue to generate business income, continue to generate, even though the person has died. Yeah, so it means that the beneficiary will continue receiving income from the sources. All right, because of that, all right, is not a one-off. You're going to be a continuous income. All right, periodically, for example, that in that case, the income is taxable in the under the trust. Yeah. So whenever you receive the income under the trust, means that now you're talking about the beneficiaries, either the wife or the children, will be taxable. All right. So how you understand whether the taxable actually is on the beneficiaries, but it's just that whether you want to tax on the total and on the trust level or you tax on the beneficiary level. So before you go into how much, actually at the end of the day, you want to know how much is the tax on the trust. No, we don't want to know that, right? We want to know how total income, right? Total income of the trust. Right? And then you also want to know how much is the statutory income of the beneficiaries. Yeah, so you have to know total income of the trust and statutory income of the beneficiaries. So that's the importance of this topic actually. At the end of the day, question we ask you total income of the trust, statutory income of the beneficiary. All right. So when talking about total income, so this number one, total income is normal. You have to do the computation. All right, under section 4A, B, C, no B, section 4A, section 4A, 4C, and 4D. Yeah, so remember that you're going to compute the adjusted income. So similarly, so for section 4A, normally it's more complex, whereby we give you the account for business income. We have all the expenses and then income minus expenses, then you have the profit. And remember that sometimes the story is interesting, right? Whereby during everything, including not only business expenses, but non-business expenses is also included in the business income, right? So you have to do adjustment, right? Starting from profit before tax, you have to do adjustment for non-business expenses. Then only you come to your adjusted income. Then you do, if there is any capital allowance, then you compute your statutory income. Similarly, then you minus loss brought forward if there is any, and then you compute your other income from your dividend, interest, and rental. aggregate income minus current year losses if your business is making losses. What else? All right, again, you do have your annuity. But remember that for your trust, normally you only have one column for trust. Unless the question asks you to compute the distributable income, then you're going to have two columns. Yeah, so you have to look at the scenario. But most of the time, if they ask you this, they will tell you, determine the distributed income of the trust. Then you have to do another column to compute your distributable income. So what's the difference between trust income and distributable income? How you decide? Whether column, yeah. How you decide whether the expenses is deductible or non-deductible under the trust or under the distributable income? Okay, remember that your total income column is actually based on the Income Tax Act. So some expenses are allowable, some expenses are non-allowable, all right? Then you also have your capital allowances. But under total income is more of a cash basis, all right? Whether expenses deductible, whether it's a revenue or capital, is deductible in arriving to your adjusted income. But remember, capital allowance is not given as a deduction because it's a concept, all right? You don't have actually money paid for your capital allowance, right? It's just an allocation of cost. So for that, all right, you compute your distributable income. What else? For example, your income from your dividend and interest, that is also dividend and interest. So the income is, dividend maybe under total income is exempted, right? Or it could be final. But under distributable income, you actually receive that amount of money. So whatever money that you receive, then you put that under your distributable income. All right. Okay. So stop at that. Then you compute your total income. So it's just that now you have your total income of the trust, right? Then you times by the 24%. Okay, 24% here is that it means that tax at the trust level, right? So when you pay at the trust level, remember that who are actually liable to pay tax? Is it the trust or the beneficiaries? Who has to pay tax actually?
Beneficiaries.
But now trust has paid the tax at the trust level. So what happens is that when you assess the beneficiary, it always has to be, so at the beneficiary must always add gross, all right? So whatever amount that you have here, total income here, right, you're going to divide among the beneficiaries, B1 and B2, right? Macam cerita banana 1, banana 2. B1 and B2, all right? Beneficiary 1 and beneficiary 2. So whatever amount gross income, all right? So once you have your gross income, remember as an individual, assuming the beneficiary, it could be a resident person, it could be a non-resident person, all right? Because the difference is that if you're a resident, then you're entitled for the relief and the tax rate will be at the scale rate. But if you're a non-resident beneficiary, there's no relief and then flat rate at 28%. Okay. Okay, what else? Okay, gross. So then remember that once you decide to determine the taxable income, tax liability, all right, whatever gross income, you have your chargeable income there. Gross income, then you compute your chargeable income, compute your tax liability. And whenever tax has been paid at the trust level, you're going to give, what do you call this?
Set off. Section 110.
Section 110. Set off, right? So how you decide, and whatever amount here, you're going to divide between the two beneficiaries, all right? So you're given a tax deduction against your tax liability, then you see whether how much is the tax liability balance or you get a tax refund, okay? So that is on when you determine total income of the trust. Trust pay 24% tax liability. Then for the beneficiary, the tax paid by the trust will be given as a section 110 set off. Is that clear?
Yes.
All right, good. Then 1E, for example, total income means that you don't pay tax at the trust level. So we are saying that this one, when you don't pay at the trust level, you are applying section 61(2). 61(2) allows the trust not to be paid at the, tax not to be paid at the trust level. So it means that whatever total income will be distributed to the beneficiaries. In terms of the computation, here is the same because whether tax paid here or don't pay, you still assess at gross. So in this case, memang, all right, it is beneficiary is actually receiving the gross amount from the trust total income. But whenever you have 61.2, it means that tax has not been paid by the trust. So who has to pay? Now the beneficiary has to pay lah. So there's no such thing as section 110 set off. So whatever tax liability, then pay lah later. Alright. And maybe the question could be, what is the benefit of having 61.2, for example, to the beneficiary? Yeah. So you have to remember that at the point of having 61.2, it means that you get gross amount from the trust total income, means that the cash flow, all right, to the beneficiaries. Rather than you get 176,000, for example, assuming that total trust income is 100, all right. So rather than having 100 minus 24%, you only get 76,000. But now you get 100,000, but you pay tax later, which is the following year, to the beneficiaries, most of the time. But remember that in order for you to apply 61.2, you have to apply to the inland revenue board. All right, it's a discretionary, then they have to decide whether they want to give you or not. But remember that the beneficiary must be a resident person and the trust must also be a resident in order for you to apply for section 61.2, right? Because we want to ensure that all taxpayers are in Malaysia so that they won't run from paying tax liability from the income received from the trust. Okay, is that clear? So this is total income of the trust, and whether tax paid at the trust level or you pay tax at the beneficiary level, the computation would be different. Okay, the second part of the trust is actually looking at the statutory income of the beneficiaries. Yeah, when talk about statutory income, actually how much actually to be taxed on the beneficiaries. How much is the income to be taxed on the beneficiaries? So when you want to determine how much is statutory income of the beneficiary, then it also depends whether the beneficiary is a what do you call? Discretionary and non-discretionary. Right? Discretionary means that in the will, it doesn't really, it's not very clear how much is the apportionment to be given to the beneficiaries. But under non-discretionary, it's very clear, 1/3, 1/2, all right? So that one is very clear, so you have to follow. So what do you mean by discretionary? It means that it's up to the discretionary of the trustee to decide how much to give to the beneficiary. And of course, the implication is that you will see that later, there is a difference between how much you actually receive, all right, and how much actually your total income. Yeah, total income under the trust for the beneficiary. All right, for example, you have B1, you have B2, and you have B3. So how much they actually receive and how much is your total income based on the apportionment. Yeah, as stated under the will or as stated or as decided. Sometimes it's not, if it's not given, for example, the discretionary part, if it's not given, then you have to look for some kind of basis to determine how much is actually the apportionment. Yeah, so you have to work a little bit extra. You have to look into how much, for example, based on the amount received. All right, for example, B1 and B2. So let's assume that B1, B2 is a discretionary and B3 is a non-discretionary trust. Yeah, so in that case, you have to see, for example, here is 0.7, here is 0.3, right? And B3. So you have to see how much to determine how much the amount received. Normally it's given to you, all right, how much is received. And T1 is actually based on the apportionment. So this one you are very clear, right? You know how much is the apportionment based on the will, but this one you have to decide lah. So maybe you want to read based on this total amount here, all right? So whatever A, B, C here, then you know A is A over total, then whatever amount, all right? So you can have that amount, then you have to decide. So what happens is that how much your statutory income, it depends on, if it's a discretionary, then you're going to be the lower of, right? Whichever lower, AB, right? AB will depends on, sorry, B1 and B2 will depends on how much receive, and the TI. All right, whichever lower, that will be your statutory income. But for the non-discretionary, is always the total income here to be your statutory income. All right, so at the end of the day, they will ask you what is the statutory income of the B. Then it depends. All right, and remember that we also have what we call accumulation. Yeah, so when you want to decide on this amount, total income, actually is based on here, whatever that you have computed earlier, all right, before your tax liability. But if you have accumulation, it means that you put aside certain amount for another beneficiary. So for that, you have to amend a bit, all right, how much to distribute. Means that you have your total income times by distributable income minus accumulation over distributable income. So this distributable income either is given in the question or you may have to compute. If it's not given in the question, then you have to compute your distributable income. Then you really have to understand the concept of distributable income. Remember, it's a cash basis, all right? Whether you pay for it or do you actually pay for the expenses or whether you actually receive the income, all right? It's a cash basis. How much you actually pay, how much you actually receive, yeah, regard to your income from the trust. Accumulation. So this is the formula that you use. So this will be deemed total income. All right. So when you want to divide here, all right, it has to be based on the deemed total income whenever you have accumulation. Okay. Statutory income of the beneficiary, of course, you know whether, then you have to decide whether to the beneficiary, whether it's a discretionary or non-discretionary. And remember that beneficiary also has the annuity. All right, any of the beneficiary that receive annuity, it will be taxable under section 4 PAP, 4E. Yeah, pension annuity and periodical payments. Even the trust actually is under 4E. All right, for the beneficiary, trust income is also under periodical payments. And finally, you also have beneficiary that receive accumulation. All right, so but remember that income of the accumulation, once withdrawn by the beneficiary, is a capital in nature. When is a capital in nature, it's not taxable. All right. So I think that what else should I cover? Anything that I have missed on the trust topic? Anyone? Tak ada. Okay, which part that you are not very sure on this trust topic? Okay, normally the challenging is actually to compute the income from the business. All right, the adjusted income from business, because normally the non-business expenses are also included. So you must identify the expenses, which one is the allowable expense, which one are the non-allowable expense. All right, in order to arrive to your adjusted income from your business. Okay, question.
Doctor, for discretionary beneficiaries, so let's say dia bagi portion like 1/4, 1/3 untuk each discretionary beneficiaries. But the amount received different daripada portion tu.
Yeah.
Kira
So whatever, it means that now you have the amount received and the TI there. The total income will be different from the, so whatever amount received tu, you put that as a amount received lah. Then you have to tell me how much is the total income based on the 1/3 just now. Remember, whatever apportionment given to based on total income. Then you have to compare kalau discretionary, whichever lower.
Okay, so anything based on amount received.
Yes.
I mean, amount received and total income.
Yes, correct. For discretionary.
Okay.
Then you compare.
Alright.
Okay. Next.
Lagi satu untuk
Can you speak English?
estate. Okay, sorry. Okay, one more for for estate just now. Like we need to compute the tax liability, right?
Yes.
For beneficiary.
Yes.
And then
not beneficiary, like estate ke trust ni?
Oh, trust, sorry. No,
Trust.
I mean the section 110 of
Okay.
trust. Okay. The tax rate, is it given or not?
Yes, of course. We'll give you the table for your individual tax as well as
And
for the non-resident person.
okay.
All right.
Thank you.
Next. Can score already lah my topic. I think that trust maybe 20 to 30 marks. Yeah. So it means that it's a big question. So if you understand very well, you can score lah. Okay. Estate and trust can score already 50%. Then you have your tax planning, right, which have been covered, and then you have your audit and investigation. Is Dr. Salwa here? Yeah, record. Okay, any more question? What about your tax planning?
Doctor, can you brief a bit about tax planning competition?
Okay. Because I'm not sure what is covered in your class, all right? But later I can give you a chapter on tax plan. Have I given you the tax planning chapter? From
I
the
think
textbook?
not
Not
yet.
yet. Okay, I will share with you chapter on tax planning. Okay, so by a normal tax planning normally, right, it's not about computation. It's a conceptual, it's a theoretical part where you have to understand, all right, given a scenario, how to maximize tax, how to minimize tax liability lah. Whatever options that you have, how can you minimize your tax liability? All right. For example, all right, normal question under tax planning, you're talking about the importance of commencement date. All right. Why is it so important for you to plan your date of commencement of your business? All right, because of course that will affect you punya allowable expenses. It will affect your claim for your capital allowances. It will also give rise to the losses for the current year, and this loss can be set off against your other income, or if not fully absorbed, it will carry forward to the following year. So this is actually the very basic, all right, understanding of your tax com. But you have to put that into your understanding. How can you actually, because you say that, for example, if you can determine your commencement date as soon as possible, then you can claim whatever expenses that you have incurred for your business. Remember that business, if you have just commenced your business, all right, normally you will not make profit, right? You will not make sale for the first few months sometimes, yeah? But remember that once you start your business, you already have your employees, all right, your workers, you have to pay for your transportation, you have to pay for all other expenses. So if these business have not commenced, then these expenses is not allowable. You cannot claim that. So that's why you will advise business to commence business as soon as possible. So how to determine what is the commencement date? It depends on the industry. For example, trading company, all right, company that buy and sell, all right, their commencement date is the first day that they purchase their stock. All right, it doesn't say that the first day of your sales, or it say that the first day you purchase your stock, that is your commencement date. So as a tax planner, all right, of course I will advise my client to purchase your stock as soon as possible. It doesn't mean that you have to make sales, but you purchase your stock as soon as possible, then you have the commencement date. So once you commence, then whatever expenses, the revenue expenses that you incur now become deductible. And remember that if you're not making profit, it means that there's no sales in the first few months or even the first year, sales is very minimal, but your expenses is very big, then you have losses, right? So once you have loss, then at the end, you may have adjusted loss. So for income tax purpose, loss is good. Why? Loss can reduce your aggregate income. All right, we will set off against your aggregate income because this one is adjusted loss. Loss from the business can be used to set off against your aggregate income. And if not fully absorbed, you can carry forward to the following year to set off against your future statutory income. And it's just that now losses can carry forward, can only be utilized within 7 years. So you have to plan. Okay, all right. So losses. And then remember that you also have to purchase, for example, capital expenditure. All right, you have to purchase all this, your shelving, all right, your air conditioner in the shop. All right, and then you have to, maybe you have to want to purchase your motor vehicle. So all this capital expenditure, all right, you can only claim capital allowance if you have commenced your business. So that's why the date of commencement is very important. All right, otherwise, all right, if for example you purchase in 2018, only 2020 you commence your business. All right, so you have incurred your capex in 2018. So during 2018, 2019, you cannot claim any capital allowance on this asset because why? You only commence in 2020. So whatever you incurred will deem to be incurred in 2020. All right, so it will take a longer period for you to claim for all the expenses. Yeah. Okay, what else? Tax planning. Remember, have you covered your group relief? Huh.
Yes, doctor.
Yes, right. So group relief is also important. Why? Because when you have many companies under the same group, all right, the company that is making losses, the loss can be transferred to company that makes profit. All right. So the loss maximum is 70% can be transferred to other two companies or to other companies that is making profit. So normally the scenario given is that, okay, I have a scenario whereby I have company A, B, C, D, E. All right, and company A is making losses, and B is this income. All right, having an income. But remember that in order for you to transfer loss group relief, all right, to another company, remember that you have to fulfill certain criteria. So on the first page, it says that at least you must be in the group for at least 12 months. The company must be a resident company. So all these conditions must be fulfilled before you can actually absorb losses or you want to transfer losses to other companies. All right, remember that company can either claim or even to transfer losses. All right, and you can actually give your losses to many companies or even one company. All right, similarly, you can receive losses from one company or you can also receive loss from several companies. All right. But because in order to avoid manipulation by companies in utilizing losses, group relief here, all right, the government has come up with strict conditions for the group relief. So not only you can transfer, but you must also be careful about the conditions in order for you to transfer your group relief. Okay, the Zoom will finish soon. All right, I think that Dr. Sawa will come up with a new session. I will join the session later. All right, maybe we take a break before Dr. Sawa comes in. All right, for the next session. I thank you. Yes.
I'm already in.
Oh, you're